So when most people get into business, they figure out that they have two avenues generally to continue to expand their portfolio. They can continue to buy properties on their own, and these tend to be smaller properties, right? Because they can self-finance them and continue to scale out that way. Or they start to syndicate and raise funds and try to tackle bigger and bigger projects. Now, these two pathways are very, very different, both from an operational perspective, a financial perspective, and overall decision-making perspective. So what I thought I would do is talk about what are the true differences if you're an investor and you're trying to consider which way to go. Do you continue to buy smaller properties on your own, or do you step on the gas and try to go down the syndication and raising money route? So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, super quickly, guys, two super quick things. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I'm putting out tons of new content literally every single day on this channel, talking everything about multifamily investing, whether it's operations, construction, deal analysis, finances, and literally everything in between. So if this is the kind of content you're looking for, make sure you subscribe. So as I said in the intro, what I wanted to really talk about was what are the differences between what your operations and financials may look like if you're an investor who's considering potentially going down and continue to buy properties on his or her own, right, and kind of self-finance everything, or if you're gonna try to start raising money and scaling out a syndication or GP business that way. Now, there's some critical components. So let's start first with talking about the self-funded way, right? And most people start out that way. I started that way. I think most people that invest in real estate usually start by buying out a property or a couple of properties on their own. And the big difference is when you're self-funded, right, versus having to answer to others. At a high level, you get full operational control of your portfolio, right? You don't answer to anyone. You can make decisions based on what's best for you and you alone. You don't necessarily have to align decisions with anyone else. So for example, right, making decisions on things like, accepting rents, right? For example, let's say you had an application come in for a unit that was maybe a little lower than you wanted. Instead of going through the exercise of like, well, does this impact my NOI? And if I'm trying to refinance and take equity out, you can just say, hey, you know what? I'm gonna hold on to this asset for another long time. I'm not sure when, but not selling anytime soon. I don't really necessarily want to squeeze the rent. Maybe that tenant's gonna cause me a little bit more headaches. I'm fine taking that lower paying tenant and calling it a day, right? Where obviously, if you are on the syndication side, right, there's a lot more consequences to think about, right? Because a lower rent roll obviously leads to a lower NOI, and if you're going to refinance or sell and reposition the asset for an exit, that's going to make a big difference on your investors' returns. Decisions like that, right, especially on the financial side, right, are going to be very, very differently made if you are the only one on the ship versus if there's others with you. So on the flip side, if you're going to be on the syndication side, as you can imagine, there's a lot more things you have to consider, right? So when you're on the syndication GP side, a lot of the financial decisions you have to think about are first for what's the best for my investors, right? So, you typically get investors who put in invested equity in. Your job really is to create the best and strongest returns for your investors, right? So, in that scenario we talked about where you potentially have an application in for lower rent, if you are potentially going to sell or refinance the asset, right, then you are going to try, then you do need to be cognizant about positioning the asset, in best possible manner for that. So you're actually going to approach that decision completely different than if it were you, right? So everything comes back to that. You're going to want to make sure your investors' return metrics are strongest, right? So you're going to think about, how do I maximize their cash flow? How do I maximize the investor's IRR? You're going to think about sell periods, right? So, do I sell within 2 or 3 years? Do I leave it 4 or 5 years? Is there additional upside where I can maybe return them a better return over time, right? So there's going to be a very different type of analysis when you've got other people's monies riding with you. Now, that's obviously a lot to consider. So let's talk a little bit also about kind of more business strategy behind those two avenues. So when you're invested by yourself, right, obviously the idea is, look, you're going to control your entire portfolio 100%, and you're going to try to build it out as large as you want or can. That's kind of the idea of it, right? Now, if you're going to go down the syndication or raising money side, it's going to be different, right? Obviously, you're not going to own 100% of each property, right? You're going to have investors come in, take a significant ownership stake in the equity based on their invested capital. You're going to get some sliver of the equity for sure, but it's not going to be anywhere near 100%. But you're playing a kind of a different game, right? You're going to be, instead of trying to control 100% of a smaller pie, you're essentially going to try and play a volume game, right? So the whole essence of this is, if you're going to go down this syndication GP business, the idea is how can you scale it up where you can buy a lot more property, right? And even though your percent ownership is smaller, the idea is the pie is so large that ultimately that's going to be more rewarding than owning 100% of a smaller pie. Now look, I've done both avenues, right? Like, and like a lot of investors starting out, like I said, when I first begun, I was buying projects basically on my own. And I realized that yes, I can own these smaller multis 100% by myself, and maybe buy one once a year, once every 18 months, whatever that pace is. Or, do I go down the raising money side where I can really try to scale out a true business, right? So this is really kind of like the logic path I had to go down to. And ultimately decided, yeah, like I really want to build out a massive, massive portfolio. Even if I don't own 100% of it, that's fine, because I believe I can build out something really, really large, scale it out, and have it be more profound than if I were to just buy on my own. Now, again, may not necessarily be the best decision for you, right? For some people, buying one property a year and doing that over and over again is perfectly sustainable and can actually yield fantastic results, right? I know plenty of people that are doing that and are absolutely crushing it. I just kind of have, my personal goals don't really match that. I want to try and build out something really much larger than myself. And that's why I went down that path and help other people along the way. So this is going to be a very personal decision for you. But ultimately, everyone kind of makes their own call about that. So hopefully that helps, guys. Hopefully this kind of gives you a little bit of clarity and gives you something to think about if you're kind of on that crossroads of, do I continue buying my own? Do I try to start raising money? Of course, if you have any questions, make sure you shoot them in the comments below.